Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Hey, this is Brent here for another week of Black and White Market Minute. Of course, got Sam, Henry, and Aaron here in no particular order. So, yeah, we can get this kicked off here.
All right. Man, this has been an incredible week for lots of different reasons, and it's all price movement. Let's try to unpack a little bit, and one of the biggest moves this week, believe it or not, was the Treasury market. And it's going to be pretty fascinating as we move forward to see if this is the reason for the big moves in almost all assets or what. Is anybody telling you one way or the other as of today has no clue. It hasn't unpacked. But lots going on. Let's get into it. Brett, what is going on with interest rates right now?
Well, as everyone's aware, I guess if you're not living under a box, that there's a lot going on economically and politically. I know when we were talking last week, 2 to 10 treasuries were all under 4%. Now 10 years sitting at 4.5%. So we knew we had some interest rate spikes, and like I say, rates are still up, so just a lot going on there.
Yeah, this doesn't happen very often. Not at all. Not picking on Brent. But the moves were so big, and I was expressing it as a percentage move, it made the conversation not work. I mean, we are talking 12% moves in, 5-year, 10-year, 30-year. That's unheard of. So you start saying, hey, the 10-year Treasury increased by 10% last year. It's like, whoa, that makes no sense. And it doesn't. I mean, you just think about all those little green things in your billfold. They do not move that fast. So it's opened a lot of people's eyes. Lots of people's eyes.
Well, in opening eyes, I think that, what do you think it was that finally pushed Trump at the last minute, I say the last minute, on his reversal? I don't think that he ignored the bond market moves. Matter of fact, I think that he even had a word about people being not nauseous. What was the word that he used? Fidgety or
fidgety. I don't know. I didn't catch that one. But lots of things can move around in this world. Real estate, stocks. We should all be okay with that.
Yeah.
But when the old greenback starts faltering, it makes people open their eyes and start paying attention. I don't know if everybody remembers, but there was a point during COVID, and it was about a 2-day, 3-day spread, and mortgage rates jumped up through the roof. And this was back when things were still cheap. So going off a little bit of memory here, but mortgages were 3%, a little bit under 3%, and you wake up one morning and they were 7%. And the next day they were 8%. And Fed freaked out. They decided, hey, we're going to start buying bonds as fast as we can and putting them on the U.S. balance sheet to bring things under control. And, it's all strange to think about because, number one, how bonds work. If interest rates go up, prices go down. So just think if the Fed starts buying bonds hand over fist, or he was buying bond ETFs, or not mutual funds, but they're similar. So when anything starts buying an asset, that price starts to increase. Well, if you have, let's say, a security that is $100 and it's paying you $5 of interest, that's 5% yield, right? Well, if the Fed starts buying and it goes up to 101, then 102, then 103, that yield keeps getting smaller and smaller. And that's what the Fed was doing to stabilize prices and bring yields down. Today it's the opposite. Yields are going through the roof because somebody's selling, and somebody's selling big. It's crazy. One of the things that we know that's going on is the basis trade blew up. And this is like picking up pennies in front of a steamroller. Big hedge funds, different institutions will go out and buy treasuries. Pretty dang safest instrument in the world. And then they'll go out and sell futures on treasuries. And over time, the price of the treasury comes to the price of the future, so you can pick up just a few pennies on every one of those trades. Well, they do that, and then nobody wants to make a few pennies, so they leverage it up, and they leverage it up hundreds of times. That all unwound. So you think about all the people out there that were selling their treasuries that were running this basis trade. And I've seen figures from 800 billion to $1 trillion just unwound in a matter of 5 days. Two things. Who even thinks $1 trillion is big anymore? Is that it? Is that all it took? Wish I had that much in my bank account, but
I wish that wasn't what we were paying on our interest.
yes. It's funny how far we've come in the last decade or two. But anyways, it was a lot of money being moved, and we know that happened. So that could be something that helped facilitate this huge drop. And the rest is pretty much speculation. We'll find out in the future what happened. Kind of going through this trade war. And one of the things that I've been reading is China is selling treasuries. This has been a big fear for as long as I can remember. I think the last time it happened was 2015 or something like that, and the world was mad. So China they support their yuan by holding treasuries, and that keeps that price pretty stable. But once they start selling those things, there's not as much backing the Chinese currency, so the price starts to fall. So if China's currency gets cheaper and cheaper and cheaper, how much is that tariff going to affect them? Shouldn't affect them at all. If the same goods we're buying for half price because the currency's down, but then the tariff makes up the difference, what really happened at the end of the day? Nothing. So that is a big rumor that is going on. There's a couple of ways, a couple of proxies you can kind of check. They were weird. I can't remember off the top of my head what they were, but we haven't seen any movement there, so there's no proof behind the China thing. Some other things that kind of make sense to me is, the market hasn't been that fun at all. And when bad things happen in the market, people make irrational decisions. So they start selling into these bad markets. The very opposite, buy low, sell high. When things get chaotic, up or down, we do the exact opposite. So we could literally be seeing people just rebalancing, especially if they're levered up. And there's some really, really big funds out there, especially in the risk parity trade, where they'll take their bonds and lever them up 3, 4, 5 times to equal the volatility of the stocks. So if that picks up, that has to come off, and it could be something like that. Another thing is there's some currencies out there that are appreciating quite a bit versus the dollar. It's the yen, the euro, even the Canadian dollar is spiking up. So if you just go back to our fear and greed thing, if Canadians' dollar is going up and then you were a trader, would you not be selling U.S. dollars to buy Canadians? So that could be part of it too, but we don't know. We don't know right now. This is so quick. Anybody that's telling you one thing or the other, it's just an agenda, one way or the other. I don't know. We don't know. So anybody that thinks they do is just pure speculation. But what do y'all think? I mean, there's so many things going on right now. Where could we be going? Where could we be headed?
If y'all remember from last week's podcast towards the end, I mentioned something in that the biggest up days come shortly after the biggest red days, the biggest down days in the market. And we just had a pretty historical Wednesday this past week, about 2 days ago. It was for the S&P 500. It was its third largest up day since 1987 at a 9.52% gain. It's actually the eighth largest day of all time for the S&P. Yeah, I kind of mentioned, I think I said last week's podcast we were due. Maybe I got lucky. I don't know. It was a news-driven pump there.
We have to say it, right? Henry's right.
Henry was.
Thank you.
Henry's right. So.
Thank you. Yeah, and I'll keep.
That was a good call.
Yeah.
Very good call.
Yeah, I'll keep going too. So as of
Henry.
as of last Tuesday afternoon, so today's Friday, April 11th. So as of last Tuesday, I believe that was the 7th, the S&P 500 had its 12th largest 4-day decline of around 12.1%. That's since 1950. All of those other 4-day declines, the 11 ahead of this past week, the average return of the S&P 500 over the next year was 32.5%.
I like that.
That's pretty cool. And those large 4-day decline years were all in 1987, one time in 1998, and then 2008, 2020. So
One thing, I'm not trying to put you on the spot or anything. I'm just curious. Did you see anything on how this compares to COVID? I know that was the fastest drop in history, and it may or may not, but it felt like a pretty fast drop to me. We were awfully busy in that time.
Yeah.
yeah, well, I mean, compared to COVID, I mean, COVID was it a month and a half? We dropped, what was it, 30% or 35?
Yes.
I don't remember.
33, yeah.
I don't think this is as fast as a drop, but it definitely feels like it. I mean, I could backdate and test it out and have an answer for you next week, but it certainly feels like it.
You know, Aaron and I have been laughing, I think specifically today, but if you've ever seen The Princess Bride, where I don't remember his name, but it's the masked main character is sitting across
Inconceivable.
sitting across from the evil, the genius evil villain, and the villain, they're doing the poison test, and the villain says, "You know that I would drink this cup, therefore I should pick that cup. But you know that I'm smart enough not to pick that cup, so I should pick this cup." And they go back and forth about, you know that I know that you know that I know. And that's kind of what, if you read headlines, they're always speculating as to what's driving the market. And it's always going to be, you know, who knows? Who knows what's driving the market? Now there's, you know, certain instances Trump comes out and says, hey, you know, the thing that's been tearing the market up the past 4 days, we'll go ahead and push that out 90 days and remove most of those tariffs, except for, you know, our main rival. Those kind of things is pretty obvious. You know, you get those big, huge days. But as that news settles in, as everybody kind of gets their nerves calmed down a little bit, people start really speculating and pushing out there, trying to figure out, and not just try to figure out, but try to tell everybody else, this is what's happening, this is what's going to happen, this is why it's happening, and
Yes.
nobody knows.
Nobody knows. Golly, I'm trying to think of that lady's, something Whitmer, or there was more than one, but one lady really called the '08 crash, and she was famous for a long time. And that's pretty much how it usually works. You know, 100% of the time. How's that go? 100% of the time it works? No, 50% of the time it works every time?
Yeah.
There's so many people out there making predictions all the time. And if you finally get one right, you know, it's 1 in a million chance, and you ride those coattails forever. So it always cracks me up when people are throwing out these predictions or telling us why. It doesn't make any sense. And right now is no different. Before we move on, going back to what changed the market, I don't care if you love Trump or you hate Trump. Everybody kind of knows he swings for the fences. He throws out the most, I don't want to say preposterous, but the biggest thing out there, scares the heck out of you, and then he backs back down to something reasonable. And same thing, the huge day. He went from the big whiteboard on the hip, and we're going to tariff these 35, we're tariffing this 25. Brought it all down to 10% on everybody except China.
Yep.
And China, he said, nope, we're still fighting this. Market loved it. China is a huge, huge trading partner of the world. So they're meaningful. But there's a lot of things that China does that's not very fair for the rest of the world. And it might behoove all of us to work together on this and support country after country to get things right. Because if we don't, you know, they're going to continue taking advantage of the rest of us forever. You know, so one of the things I really hated was the media trying to put a big division in people, in the country, the president, all of that stuff. And it doesn't matter what you feel. When we're dealing in global things, we need to come together as a whole. And I'm trying not to be political, but, if half the country is against what's going on, what does China have to do? Wait 2 years? Who wants to go through 2 years of this stuff? Let's all come together, get it fixed, and then we can hate people tomorrow. I know that sounds bad, but golly, this isn't fun. We should all benefit. I wish there was something that could just bring the whole country together. It sure feels like that's not going to happen or won't be able to happen for a while, but it would help us now. Back to the market. Wednesday was a huge day. Trump came out, lowered the tariffs. That's what everybody wanted. And this market feels like it just needs a reason to go back to where it was. Henry, what was that number? 32% or something after drops like this?
Yeah, over these really big 4-day declines that we get in a row. The next, I think we're 11 for 11. The next 12 months we're always positive. I think the lowest return on one of those years was 12%. But yeah, I got another fun fact for y'all. So here we go. The volatility index, the VIX. The VIX hit 60 early on Monday morning or Sunday night, which is really high. It's actually historical. We've only seen a print of 60 on the VIX 4 times since 2008. That was a few times in 2008. I think we got up to 85, 90 back then. Another time was the 2020 COVID crash. And then actually recently, this past August, the VIX went up to 68 during the Japan carry trade. So yeah, so just some 1-year returns following a print of 60 on the VIX back in 2008. The next year was a 22% gain. And then as we know, in 2020, March of 2020, when the VIX was above 60, we had a 65% gain the following year. So now we're in 2025. What do y'all think?
It's going to go back to normal. One thing, me and Sam were actually talking about this week. If nobody knows what the VIX is, it's a volatility index, and they use options to put in the calls to see who's buying what and how much. That's pretty much how they come up with it. But if you hear anybody say, hey, the volatility of the market is 18% on average or 15%, whatever that is, that's basically quoting the VIX. And fun thing is, market always goes back to normal on volatility. It can get crazy, and then it sinks back to normal. So there's a way that you can profit from that is once it hits 45, 40, anything high, you just short the thing, and then when things go back to normal, you've made a decent little profit. That's not something we do because that's just straight derivatives, and it's a little bit risky. But one pretty sure thing is things get back to normal. So, fun fact.
Speaking of volatility really quick, whenever you're looking at VIX spikes, you're looking at really volatile times. I was actually looking at spreads on ETFs yesterday and today. Now, whenever I'm talking about spreads, I'm saying, you have somebody out there trying to buy the ETF, you have somebody out there trying to sell the ETF. And the difference in those two bids and offers, that's what I'm talking about, the spread.
Right.
On normal times, I'm not going to say the average, but the specific one I was looking at was 3 cents. And that was for a lot of February and March. And then you see that spread widen to 5 cents. And you could see that was the lead up and a little bit more market volatility. And then Trump came out, made his announcements, and that jumped to 9 cents. And so those spreads, they make it a lot more expensive to be active traders. And that's why between that and taxes and the unpredictability of the market, the unpredictability of the tweet policies and things like that, that's why it's more beneficial to be investors. The follow-ups to the spikes in volatility and you don't want to miss a day in the market because it could be a Thursday.
Right.
Yeah. So,
that is exactly right. That's one of the painful things about trading is there's always a cost. You would think It's 2025. If I wanted to sell something, I could do that pretty easily. But there's always a broker there. Just think about a real estate broker if you're trying to buy a house or anything. Someone's there for a commission, and that's what the big guys do. The big brokers like Fidelity or Schwab, any of them, they want to get paid for that trade. And to Sam's point, if I'm selling something, right off the bat, Schwab has to buy it from me. So if things are crazy, how excited are they to buy something from me in the short term? And we're talking today. When that risk really spikes up, they're going to say, I don't want to do this, but I'll do it for this price. And that's why we kind of see those spreads pick up in those times. It is pretty neat to just follow along. This is so short term to see how those spreads widen. I never really looked into that until you started doing it. I mean, just to see it on paper. We know it happens, but to actually see it, that's pretty neat. So what's it going to take to get things back to normal?
Assurances. I think it's going to, certainty.
Certainty. That's really it. The market wants to go back. The market really wants to go back.
You can tell by Wednesday's move.
Yeah, Wednesday's move was huge. What day was it? Monday. There was a rumor of a tweet, and the market went from 2% down to 2% up. And
10 seconds or something?
Yeah.
Fake news.
Just fake news.
Well, it was fake news on Monday, but it turned out Wednesday that was the actual news, and then Trump said, I saw Wednesday morning, he tweeted out something, he just said the word buy or something, and
He said it's a great time to buy, yeah.
Great time to buy, and we just all sat there here in the office, or maybe
Right.
Sam did.
It's funny. There's a big difference between retail and institutions. Retail is anybody but Harvard or big pension plans. We're actually institutional buyers. But, I mean, just your everyday folk that's making decisions on the brokerage, that is usually retail. They're wearing out. But institutions are sitting there hovering with their finger above the buy button. And just wind blows wrong and they're hitting it. And that's all we need is some certainty and some reinsurance. We're really, really close. One of the things that could really help us out is the interest rates. And we kind of talked a little bit about how crazy that's been this week. We've discussed, I think last week, interest rates are nothing but the cost of money. So the lower the cost of money, the more people want to invest, the more people want to leverage. It's kind of funny, Fed just recently met, and they've been actively talking, and they said everything's fine. We're not going to lower interest rate. The rest of the world is lowering our interest rates. Brent, what was that on the short-term stuff, the 12-month? How much did that increase over the last week?
The 12-month increased 5%.
The 12-month? So that's still under 4, right?
The 12-month?
Yeah.
It is. Yeah, I mean, it's right at 4.
Okay. So everything else is up double digits, 12%, 10%. Super short-term stuff did not move as much, is about half as much. And that is actually the market, everybody in the world buying and selling and determining what that stuff should be. The Fed came out September of last year. Let me see what this is, the Bloomberg Financial Conditions Index. It was at 0.5. 0.5. So we're still in expansion mode, and they cut rates, and they cut rates a lot. Today, that same index is down 0.895%. So we're contracting. And the Fed comes out and says, oh, no, everything's fine. Inflation's come down. We've had some great prints on inflation. Energy's come way down. Everything is, I think everything but food. Wasn't it food? Everything's looking good, and then the Fed is not budging. Everybody's telling them.
Fed's always late.
I think it's a transitory not cutting of rates is what I expect.
Transitory, yeah. The more we can throw that word out. I hope I can hear my grandkids say the word transitory. I know it made mainstream. But, I mean, my whole point is how much is this is political BS?
Henry actually texted me the other day about somebody removing a recession.
Is that a word?
What, texted?
Texted?
Messaged?
Text.
Text. Henry actually texted, yes, it's a word. Henry actually texted me the other day. Who was it that removed their recession forecast the instant Trump came out? And
Yeah, it was Goldman.
Goldman Sachs?
Yeah, and that was only out there for like 20 minutes, wasn't it? Or maybe half a day?
35% down to, what was it? I assume zero. Not sure how much they reduced it by. I thought they just got rid of the forecast. It's just all politics. That's what we've been saying.
Someone got escorted out of the building. But, again, we're just looking for that reason. It'd be great if, the Fed would be apolitical, look at everything that's going on. And if you kind of think about it, we got just a few Fed presidents and their thoughts versus how many participants in the market that are 100% against them, saying you're wrong and trading this a different way. I kind of hope that our Fed is right, but if they're not, this is getting very, very strange how stubborn they're being. And this is where, again, when the dollar, the Treasury, all that's where the rubber hits the road. So if we start talking about liquidity crisis or shortage of the dollar, any of that, that's when pricing starts to move a lot for no apparent reason other than I need money now and I'll do whatever it takes to get it. That's liquidity prices and or liquidity problems. And
Everybody hovering over that sell button.
Yes, we don't want that at all. Even if we're at, 395, we still have to look out the rest of the world. Where's the yen? Where's the euro? Where's it all at? And they're all dropping like flies. Euro's in a full-blown recession. Something's got to give. And hopefully it's tariffs all coming together, all getting on the same page and trying to move forward. Anyways, lots of crazy things happening. And all we need is one good thing, and I think we get back to it. I'm still excited. Kind of feel bad about the small move today. It was good to see some green, but I was kind of expecting to see some bigger jumps, similar to Wednesday, maybe not, maybe a third as big or something like that. Still some fantastic companies. Did I talk about Texas Pacific last week?
No.
It's a land company, has royalties. West Texas, one of the largest landowners in the country. That stock dropped 21% in like 2 days. 2 days. You tell me what land does that unless you're forced to sell. I mean, that stuff is exciting. I mean, that's a true Christmas gift.
Yeah.
I'll take it. I know no house drops 20% or section of land, but there's a lot of craziness out there. So it's still super exciting, and I would love it if things kind of stabilized, where the fear disappeared and people weren't scared, and we could have a little bit of time to really take advantage of this and get exactly where we needed to be. So whether we recover in 1 week or a month, we're there, So good times ahead. Hopefully it's that 32%. I think we're going to be there. Just don't know if this is towards the end or somewhere in the middle.
18 months.
Yeah. I don't see the 18 months. There's too many great companies out there selling at a huge discount that we have to have.
And there's still a lot of cash on the sidelines in the world. I mean, with interest rates where they're at, you can get just about 4% on 12 months. I mean, if you don't want to buy market, you can just put it in cash and...
Yeah, plenty of stuff on the sidelines, plenty of fuel for the fire. And, it's just human nature that you want to be able to take advantage of good things. So once that market takes off, you're going to want to be one of the early ones instead of the late ones because it will go fast. Let's see if I missed out on anything. I think that's about it. So everybody hold in there. unless you need all your money today or this week, it's an exciting time, and it is a good time because this is pretty much silliness, and we're taking advantage of it. Once we get to the other side, we're going to feel so good. This is one of those things that can change an account, changing a life, whatever it is. This is exciting and not scary. So everybody hold in. Our earnings for the companies that we hold start in next week. So this is where we really see what's going on, and I'm ready. I'm excited. I think earnings are going to be fantastic, and we'll go from there.
Yep, just like Trump says, hang tough, everybody.
Hang tough. All right. Well, everybody have a great weekend, and we'll see y'all next week.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.